Hey, hey, hey! Welcome to the show, Trader Friends. And we have a very special new guest for you today, all the way from Stockholm, is Patrick Thomenius. Hey, Patrick.
Hello, Angie. Hello. How are
How
you?
are you? You're looking
I'm just
very
great.
smart in your IG gilet,
Thank you.
which,
Just received
hint,
it.
hint, no one's given me an IG gilet here.
I like wearing it. It's new. I just got it, and it's brilliant.
How's it going over there? What's the temperature like? It's a miserable, slightly damp 3 Celsius here. What's the real
Mm.
feel in Stockholm?
It's miserable here as well. We'll probably have, I don't know the degree exactly, but we have around that.
All
A
right.
bit rainy and just gray.
But
But at least we're happy.
yeah, and you still got that holiday glow because I know you've just come back from holiday. Let's kick off with a brief introduction. Introduce yourself to our trader friends who are watching, who are very, very interested. Patrick is, of course, market analyst in Stockholm. Tell us a bit about your day-to-day.
Yeah, sure. Yeah, so as you said, I'm just new as an analyst here in Stockholm and started in December. I have been a stockbroker before this, and but in between I worked on the regulatory side, especially within the AML field. So I will be helping our clients look into the markets, what's happening, and trying to explain what's going on. And so that's me. Day to day, I write a morning report, and I will hopefully try to write some articles that will end up in the Swedish newspapers. And then I have similar to this talks with some newspapers in Sweden. So tomorrow I will talk on Dagens Industri, which is one of the biggest.
Talk us through the analysis that you've been churning. I know you look a lot at liquidity. It's been such an exciting last few months for all us traders because we had that whole election, which was pretty much a shoe-in, but then there was a lot of positioning, rejigging of that as we came up to the end of the year. Markets soaring, if you're talking about indices. A lot of our clients trade indices here, and now it's almost like the calm before the storm. Of course, Trump, just in the first week. What is your analysis telling you about the coming weeks?
Yeah, sure. I mean, as you said, our clients trades indices. The most traded are the Nasdaq 100, the German DAX, of course, and the Swedish index, the OMX 30. So it's interesting to see where our client sentiment is. And at the moment, the clients are 55% long Nasdaq. They're short, 80% short the DAX, and they are also short the Swedish OMX 30. So 60% are short that. So I'm kind of bullish the US market. So perhaps people are taking a long position in the US market, shorting the European, which could be good. But since Nasdaq and the US market represent a larger part of the world market capitalization, I tend to look to the US, what happens there. And as you said, a lot about Trump. A lot of that is noise, and I like to see through the noise, see what's going on, especially talks about tariffs, stuff like that. So we could definitely talk about my views on the tariffs. But basically, my market view on where the market or indices are going are 3 major points. So that's market liquidity, company earnings, and market sentiment. So that's what I tend to look at.
Do you think the tariff talk is a way of Trump just making more noise? I mean, I know he has signed these orders, but at the moment Europe seems to be having a bit of a relief rally because nothing's been said about Europe yet. Mexico, we knew that before, but also the fact that there is now this feeling that perhaps the tariffs won't be as bad as initially thought, or do you think this might widen out in the coming months and we're going to see more jurisdictions, more countries being caught in that Trump tariff net?
Yeah, exactly. So definitely, and I think that's a good point. So I tend to look at what happens or what's the impact of tariffs. And the Federal Reserve of New York actually did a study of that a couple of years ago and found that the US domestic prices will be immediately impacted, of course. Back in 2019, they found that CPI would be 0.3% higher giving the tariffs than without. And at the moment where we are at, looking back at the last CPI number, as you know, it came out at 3.2, below expectations, but just barely. So it was sort of rounded down from, I think it was 3.24 or something, could be just as slightly rounded up as coming in as expected. Jobs report, smoking hot, 256. And so, I mean, there's not that much room to play with for Trump, especially if you look into interest rate expectations. So interest rates expectations has fallen in December from 52% to 26 here just the day before. And I think a lot of analysts are actually looking into these kind of threats and actions having an impact on CPI. So I think I wouldn't say his hands are tied, but he is a poker player, and he likes to leverage this to get some deal or some better deal, of course. So that's what he's playing. I'm not convinced that we'll see that much tariff because of this backdrop of inflation, risk, CPI, etc.
You like paying a lot of attention to the federal budget deficit as well, don't you? You know, we have a lot of discussions about this, quite controversial ones, because, you know, there's a school of thought that actually the deficit is going to get to a point, and of course the debt levels too, that it starts freaking out the, you know, the wider investor base in US debt, and that starts having an impact on assets around the world? Or are you the other school of thought where you think actually Trump is going to take that slow change approach where he's tweaking but making so much noise elsewhere, no one knows that he's tweaking, and he might sign an order to relax the borrowing rules? Which side of the camp are you on?
Yeah, so great point. I like to look into liquidity, and a large part of that, if you look into US domestic liquidity, is of course budget deficit. It's been running at a high pace, and we just got the prognosis for 2025 from CBO just the last week, and the deficits are projected to be even higher this year, and going forward they're going to be just keep going up. So I see that we are in an environment that it will be harder to actually do something about US expenditure, especially as a larger part of that, and an increasingly larger part of that, is paid on the interest, and that will just keep going up. I think at the moment US have the highest average interest payments since the last 10 years. So that will of course affect where US expenditure is going and the deficit. So I think at the moment we are in a phase of fiscal dominance, so that the expenditure from US government can actually sort of subdue the effects from the central bank. So I guess would be that kind of new stage or new type of theory of monetary thinking, that going into 25 and beyond, it will be harder to do anything about US spending and deficits. And we just saw Vivek leaving the Dodge, but I think the Dodge will have that problem of US spending being just the train that keeps on going. It's hard to stop. And
that momentum.
Yeah.
And it's interesting, isn't it? Because, you know, no one wants to be the first one to step off if the momentum's still going that way. And yet, Patrick, you look at the figures, and these are not mine, by the way. These are the CBOs, and I know you know, talk about fiscal dominance a lot. You know, it's clear to see that, you know, budget projections. This is for 2025. Outlays going out 7 trillion, coming in 5.2 trillion. I mean, you know, my 9-year-old kid can tell you that there's a huge shortfall there. And debt held by the public, 30 trillion and rising, right? The US debt clock, which I put up earlier, that page makes my eyes bleed. You know, 36 trillion and rising there. And yet we see that, you know, whenever there's a debt auction, I keep an eye on those as well. I don't know whether you do. There seems still to be appetite out there for that debt. I mean,
so the dollar is a reserve currency, and I'm not worried at all about total debt or debt held by public. We are at a record high, but that's not really the issue. So what effect does the deficit have? It stimulates the economy. So it's bringing liquidity to the markets.
Right. So you're worried about the inflationary side of it.
Yeah, so not really that worried either at the moment. I think investors should have in mind that interest rate could be more of a flat this year than going down due to that. But in the liquidity space in general, I think we're kind of flat this year. So we have this offset by the central bank having the tightening together with the government spending. So it's an offset, and I think we'll be flat liquidity-wise this year. But the total amount, I'm not really concerned. There needs to be a dollar out in the world, and one way to get them out are running a trade deficit. So also going back to the tariffs and Trump's speech about that, the US literally needs to have a trade deficit to just bring out dollars to the world and keep up that reserve currency going. So total debt, don't look at it really that much, but it's just the interest expense on that debt that piles up together with the deficit. That will be really hard to get rid of, and that will be inflationary over the next 10 years. So we will have the sticky inflation over the next 10 years, and that you really have to consider looking into what you think about interest rates and the market. But market tends to like stability, but also liquidity. So I think that could be good, at least for this year.
So it's good so far for this year. Where might you see cracks? So where are the Patrick Thomenius red flags for you? Are there specific signals that you watch out for that kind of say, well, actually the train is slowing down, the momentum is really slowing down now, and we're seeing a shift?
For sure. So I have these 3 metrics, of course, that are important to me. That's liquidity, earnings, and sentiment. And at the moment, as I said, I think we're flat liquidity-wise this year, but company earnings are really, really strong. As you know, if the expectation is around 12.5, I think if we reach that, it will be the highest Q4 earnings in the last 3 or 4 years, I think. So those are really good. Market sentiment, I think, is good. People are generally bullish. So going into this year, I don't want to have a narrative for the whole year or so, or for the next couple of years. I like to look into the data, and data today is showing me that I can be bullish. I think looking for next year, if earnings would come down, be a bit worse than today, or if market liquidity would also be coming down, that will be an issue for going to 26. I don't really see that today. Could be happening, but I mean it's far out. So I don't think we are in the end of that cycle this year. At least we have 10, 12 months to go. Sentiment is something that was really interesting this year. I think going into a year where leverage is high, I think we could have some bigger drops. We could definitely see some intraday trading on the bigger stocks going down 10% at least. we have seen that on earnings reports
Sorry
previously.
to disturb, keep that thought. Just to be clear for our viewers, when you say market sentiment, do you mean the volatility index? Is that what you mean?
No, so yeah, I look at the volatility index. I think that's kind of low today at 15, 16. I don't see, as I said, the major points are bullish, but I think the premium for downside should be a bit higher today where they are. I think that during the year we could have some volatility events bringing down certain stocks, but also the bigger indices up in the higher one digits, so up against 10%, and that you should really have in mind. Being too leveraged this year could cause a lot of pain, and you could really be stopped out. That's not really the main. Market sentiment is just a lot of different metrics. The volatility index is one. I kind of find that being a bit laggish and not being really a leading indicator for that, but just seeing where our clients on the platform are trading, how they're trading is also one of those measures.
Great. And liquidity, just to be clear, lots of people asking, our trader friends saying, what metrics do you use for liquidity?
Yeah, so you have the domestic liquidity in the US, and that's of course central bank. Are they easing or the monetary base, or are they running a QE, or are they tightening liquidity through QT, quantitative tightening? So they're currently running a tightening scheme and bringing down asset and the balance sheet. I also look into the reverse repo, and the last couple of years we have, since 2023 at least, added liquidity by bringing down the reverse repo. Then you have the budget deficit, as we talked about. Credit availability is also one of those measures that I use for liquidity, and that is our bank tightening standards, lending standards, or those standards, are they easing those standards? So one way to look into that is the senior office opinion survey on bank lending, and we'll have next one here for January, but the last one was it's a bit flat at the moment, so basically unchanged for lending standards for commercial and industry, but tightening loan standards for smaller businesses. And another measure for global liquidity is the strength of US dollar, of course, and that has been rising since October 2024. Yeah, so those are the main metrics for liquidity.
The interesting thing about the dollar, just showing up the punching up the dollar chart for you. This is the US dollar basket. I'm going to put it on the daily time frame. Is that you know, it's had such a run up, right? It's had such a it's been on tear since October, and then it's kind of come off that just after Christmas, and is now sort of at the 10787 handle. It'll be interesting to see if it stays at these levels or comes back off, because essentially Trump wants his voters to feel richer in the pocket, right? But at the same time, he wants to make sure the US economy is going full steam ahead, and he can't really do that with a very high dollar either. So it's going to be interesting. We were just talking about this the other day with some other analysts, Chris Beecham and also Aaron, and the volatility desk here at IG. Monty as well, who runs our client sentiment survey out of Dubai, also chimed in, and we came to the conclusion that perhaps stronger dollar in the first half of 2025 than maybe weaker dollar in the second half of the year, you know, once Trump's policies start playing out. What do you think?
Yeah, so I don't have that good of a prediction for the dollar index. I tend to follow it to measure liquidity and just the strength of the economy. As you said, there definitely an impact on US consumers, but I think one of what's happening now is a bit of noise around Trump's different speeches about tariffs and alike. So in the short term, it depends on Trump and tariffs, but one major part of the dollar is, of course, U.S. interest rates. And as we spoke about, the expectations have come down from quite high expectations for a lowering of the rate in March. And I think that if we'll reverse that, and the interest rate will be around flat, or just have perhaps one lowering this year, that could definitely impact the dollar strength. So if you're going to trade the dollar, have that in mind. That look into the CPI report and have that in mind. What Trump does with tariffs could have a large impact on the CPI, and then eventually interest rate, which could have impact on the strength of the dollar, of course.
Right. And on that note, we are counting down to Trump's incoming speech, and of course the Bank of Japan as well. Before we go, Patrick, it's been such an enjoyable time speaking with you, but I know you're a very busy man and I need to let you go. What is the rest of your day looking like?
Just preparing for tomorrow. I'm going to talk a lot on Dagens Industri, which is a big newspaper here. So just have to prepare for that, and just having a look at what happens in the market. I mean, as you started off with, every day is something happening, and especially with Trump at the steering wheel. So that will be my day. But lovely speaking with you, Angie. I hope to see you again here.
Definitely. Tack, as they say, tack tack in Swedish.
Tack så mycket. Tack, tack.
It was lovely working there when I was in Lund and Malmö and Helsingborg. Right, we'll get you on and see you next week.
See you.